Hello, everyone, and welcome to today's webinar on cryptocurrency. What is it and why should I care? I'm going to jump into today's presentation with a quick background on myself. My name is Mark Eckerle. I am a senior manager here at Withum. I work primarily in the audit side, and I've been with the firm for a little over 3 years. I joined the firm to really lead the Withum's crypto and blockchain sector. And over the last 3 years, we've really kind of established ourselves in the marketplace. I brought to the firm 6+ years of experience kind of auditing and accounting for cryptocurrencies, as well as companies working in the blockchain technology space. Obviously, the first thing that comes to everyone's mind is understanding taxes. So that's a common question we get here. As usually auditing is down the road, accounting and taxes are the first thing on everyone's mind. So I kind of have experience working in all three arenas. So any questions that come up, I'm kind of well versed in all of those. But jumping right into today's presentation, these are the three things that I'm kind of going to go break down as we're going through. I don't think you could talk about cryptocurrencies alone without getting an understanding of what blockchain technology is. So we'll start off with a brief intro to crypto, understanding the most common assets, and kind of giving some examples of how to acquire these assets as well as store them, just because it's really not holding physical cash in a wallet. It's a little bit different, so we'll talk about that a little bit. And then we'll give a brief intro to blockchain technology. It's kind of a buzzword, so we'll get an understanding of what that is today, as well as the impact that it has on today's business environment. And are we seeing it? What should we expect from kind of the consumer perspective? And then lastly, we'll kind of go into the impact that crypto as well as blockchain is having on today's world. Kind of how does it impact us? Why should we care at the end of the day? I mean, the US dollar is not going anywhere, so what's the transition going to look like? What's the use cases around crypto? So we'll take a deep dive into that as well. But I mean, jumping right into it, introduction to cryptocurrencies. We'll start off with Bitcoin. That's obviously the most popular cryptocurrency out there today. Bitcoin is the first distributed, consensus-based, permissionless, peer-to-peer payment settlement crypto. Now, what does that all mean? Peer-to-peer means I could send it directly from me to you. There's no intermediary third party, which the whole point of crypto is to kind of remove that intermediary. Think of it like the banking system, right? So I don't have to go to my bank to request a wire to send out. I don't have to, my credit card transactions are settled with a third party. So it kind of alleviates that. I am my own bank. That's the core consensus when it comes to a lot of these cryptocurrencies, is really taking title to your assets and not having someone else kind of oversee them. So Bitcoin was the first distributed, permissionless, peer-to-peer payment settlement. Permissionless means distributed and permissionless are basically that it is a full-blown network where there's an algorithm or consensus model where everyone on the network agrees that I have said funds in my wallet, and then I can disperse those funds and use those. So it's kind of agreed upon by the community and by the miners, which factor in when we talk about what blockchain technology is. But basically, at the end of the day, it's Bitcoin is the first crypto that's come around back in November 2008, and it's kind of been really paved the way for a lot of these other assets. To date, there's over 12,000 different digital currencies out there. So it's really the ecosystem and landscape has really grown significantly over the last 12 to 13 years. And that's kind of where the inception of Ether or Ethereum really came about. That came roughly 3 to 4 years after Bitcoin was announced and became public. And these are the two most popular digital currencies out there, or cryptocurrencies. I use those terms interchangeably. So Ether is really a good protocol for building applications, right? Decentralized, or DeFi, as the term has been coming around in 2021, is a decentralized finance, where you can build decentralized applications for use cases on a blockchain. And Ether is the native token on the Ethereum blockchain. So when people say Ethereum or Ether, Ethereum is the protocol or the network. Ether is the asset run on that network. The distinction between Bitcoin is also the token as well as the Bitcoin blockchain. So those terms are a little bit interchangeable there. Stable coins is very important this year. We've seen kind of stable coins come about the last couple of years, but lately they have really come to prominence because of their use case. So they are essentially pegged one-to-one, typically to a fiat currency like the US dollar. They attempt to reduce volatility by retaining that peg. So if you think of transacting in Bitcoin, you're always playing that volatility game, whether the asset's going to go up or down, trying to hedge against it. Same thing with Ether and a lot of the other cryptocurrencies out there. But the benefit that stablecoins have is it's easily denominated to the current financial system of either the euro, the US dollar. We're seeing a lot of stablecoins pegged to other commodities such as gold, nickel, silver, things like that. And I think that is where the marketplace is really going. The stablecoin ecosystem has really been evolving lately. And I think that's an easy on-ramp into the crypto world, right? So Bitcoin, the volatility kind of scares a lot of people away. But if you understand the use case of stable coins, it helps to transition into the rest of the crypto ecosystem. And we're seeing stablecoins, it's more of a global landscape, right? I mean, there's countries that are transacting in stablecoins just because of the payment rails and the cross-border use cases. So if you wanted to send money today overseas or to another country, it's not as easy as you would think. Going to a company like Western Union, it's the obvious example. The fees involved, the timing to transmit those funds, where it can take 3 to 4 business days. Weekends typically aren't included there. Best part about the crypto world is the never closes. Weekends are fully operational same time as during the week. And the cross-border payment system, it can be settled very, very quickly. We're talking, I don't want to say seconds, minutes maybe, just because of just getting that process confirmed on the network can take a couple minutes, but it's essentially fast as lightning compared to the current system or financial system that's in place for cross-border payments. So that's where stablecoins really come in, because it's easily denominated into today's financial system, and the timing for settlement transactions is really key. So how would someone go about acquiring these assets, right? And how are they stored, right? Like I mentioned earlier, it's not in a wallet, so you're not holding cash physically. So that's a big difference. Everything comes back to our phones, right? We're in a digital world now, so we kind of work everything off of our phones, applications. You hold crypto in a wallet, and it's a digital wallet. It's typically a 20 to 30 letter or number passphrase, and that wallet is basically yours. There's no FDIC insurance on it. It's not, you don't, if you lose that, it's not, you can go complain to your credit card company, go complain to your bank and say you misplaced it. It's one and done. So there's a lot of kind of uncertainty around the security of these assets, just because it's very nuanced, and you want to be extra careful when dealing with these or transacting with these assets, just strictly based on the fact that if you send it to a wrong user, those funds are gone. So you just want to be extra careful when dealing with these assets. There's a lot of third-party custodians and exchanges where you can go and buy and hold these assets, which are a great example for a lot of newcomers into this space. You think of companies like Coinbase, Gemini, Kraken. A lot of those are the common exchanges here in the United States, and they have great security. Most of them are SOC tested, so they have their security controls in place, and it kind of alleviates and gives you the peace of mind as a user that as long as you have your access, your username and password to access your account, same way you have for your email address or social media accounts, then you can access your funds. And those are available both on the web as well as on your phone via application. So kind of you have the availability to access them on the fly or wherever you are. And that would be a good kind of first step or on-ramp into the ecosystem. Again, if you're kind of a little bit more experienced, you can have your funds kind of in a hardware wallet, what we say, where it's storing them in a what looks like a USB drive, and you can carry that anywhere you go. It's called cold storage, so your funds aren't at a third party. You take title to them. If you lose that device, again, those funds are gone forever. So you always hear those horror stories where someone had Bitcoin on a hard drive and they're checking landfills because they lost the computer or the hard drive crashed. So don't want that to happen to anyone here. So definitely be extra careful when it comes to storing your digital currencies. And as I mentioned earlier, without understanding crypto, you really have to understand what blockchain technology is. So I'll do a quick intro to what that is. I mean, a blockchain is a form of distributed ledger technology. It was introduced in the Bitcoin white paper, but there has been time and time again attempts to understand blockchain technology the last 30 years in the cryptography world. So maybe we have not heard of it, but there's always been someone trying to work on a great use case to really implement blockchain technologies. We've adopted the internet since the mid 90s, kind of since that came around. And basically, a distributed ledger is a database that is shared by multiple participants in a network to eliminate the need for a trusted central third party. So as I mentioned earlier with Bitcoin, the goal is to really take title to your assets, and it's all supported by blockchain tech. So being able to have that consensus protocol underlying these assets is critical to making the whole ecosystem run. So the Bitcoin blockchains, that's the common example I'll use, is supported by miners in the concept of mining. And without getting too technical, they basically approve and validate transactions on the network, and they are rewarded for their efforts with new Bitcoin that is introduced into the ecosystem. So that's basically the flow. How new Bitcoins are minted, are rewarded to the miners, and miners for rewarding for using their computing power through the mathematical equation of solving transactions and basically validating them and publishing them to the network are awarded with those newly minted tokens. And anyone can go visit the Bitcoin blockchain if you want to go see transactions happen in real time. That is blockchain.info. That is the website. If you want to plug that in, you can see transactions happening in real time on the Bitcoin blockchain. So that's always a good thing that I always like to show new people into this ecosystem is if you want to get an understanding of how it works, that's a good visual tool. I'm a visual learner myself, so that's how I like to operate. Now, is there only one? I've been talking about the Bitcoin blockchain, but there are multiple. Right? There are technically two types of blockchains: public blockchain versus a private blockchain. Public is the example of Bitcoin, where I just gave you the website, blockchain.info. If you want to go on and watch transactions happen in real time. The Ethereum blockchain is also a public blockchain where you can go on in real time and observe transactions. Private blockchains are a little bit different. Those are examples like IBM Hyperledger, where IBM rolled out a kind of blockchain suite product where companies can adopt blockchain tech, where they're not publicly broadcasting their transactions. So when you hear of companies adopting blockchain technology, more than likely they're using some type of private blockchain, where it's, if you think about it, for supply chain management. So I know a couple of years ago, Walmart was one of the first large corporations to really kind of dip their toes into this space, and they were doing it via supply chain management and understanding kind of the provenance of goods. So think of it from a fruit, right? They want to know where their bananas came from or their apples came from. It's really tracking those apples from where they were picked to basically how they ended up at a store. So uh, just in case if something were to happen, there was some contaminated fruit, they would be able to trace those and what they came in contact with. It's basically putting an ID or uh, a tracking mechanism on that good. So that would all be tracked on a private blockchain as an example. Whereas if you think of Bitcoin or Ether, those are more public transactions. And there are multiple, right? So as I mentioned, Bitcoin has its own blockchain. Ethereum has its own blockchain. Some of these private companies will each have their own blockchain. And what that would look like if you're thinking of the IBM world, if there are multiple companies that are creating their own kind of back-end blockchain for whatever use case they have, that would be their own separate model. So think of it, I'm an accountant, so I'm going to fall back on accounting terms. Think of it like your own QuickBooks system. Everyone would have their own QuickBooks. It's not not every company's QuickBooks is talking to each other, so it's kind of your own closed-in world of transactions, if you will, for whatever use case you are using it for. And now, how do these impact me, or us, I should say? I'm a big proponent of cryptocurrencies. If you can't already tell based upon my presentation, I've been working in this space for 6+ years. I am a firm believer crypto is here to stay. And I think just based on the last 12 months, current prices, it's really grown as you've seen a shift in today's ecosystem. We're seeing countries adopt Bitcoin as a legal tender, such as El Salvador earlier this year. I think we will continue to see more and more countries adopt. I don't know if it'll be Bitcoin, maybe some stable coins as a legal tender. One idea that's come around in the last 18 to 24 months is the idea of central bank digital currencies, or CBDCs. If you think about that, that would be a country coming around with their own form of digital dollar. So think of the US dollar in a digital format. Now that's separate from credit card transactions, because I know we all kind of already transact in somewhat of a digital world, or we're swiping from our phones, we're checking out. But this would be kind of an alternative that complements the current physical cash system that we have. So it would be a digital, it would increase payment settlement transactions. It would be easier to perform cross-border payments. So a lot of the proponents that stablecoins offer would be parlayed into a CBDC, or central bank digital currency. So I think that's, rather than seeing a lot of countries adopt Bitcoin as a legal tender, I think we're going to see a lot of countries come about and introduce their own form of digital currency that's pegged to their own native fiat. And then blockchain tech. This is where I think is going to impact companies the most, because we're seeing a lot of adoption, but a lot of it is behind the scenes. So it's not really impacting us yet. I know it's a buzzword. I know when people think crypto, we think Bitcoin might be here, it might be zero, but blockchain tech is here to stay and companies are adopting it. I don't think we're going to see that tomorrow, and I don't think we're going to see it in the next couple of months. I think over the lifespan of this industry, that'll be the more prominent takeaway, is the impact that blockchain technology has had. And you think of use cases I talked about earlier, supply chain management with the system that Walmart introduced, but there are a ton of other ways that blockchain tech can support us. Just a couple that I can think of off the top of my head are real estate. So I recently bought a house within the last 12 months, and the title and process of registering my title or my deed with the county was very manual. So I think kind of taking title, publishing that to a blockchain as a stored registry, distributed ecosystem, it would basically be as simple, if you think about the concept, simple as the previous owner transferring that to me. And that would be publicly available to anyone, assuming it's on a public blockchain, of course. But that would be a good use case. So I'm not going back and forth registering with the county. Like, you could just see that the previous owner transferred that to me so that I have title now. Another one would be healthcare. And I think this is going to be a major impact to shake up the current healthcare system. So what I mean by that is basically owning your medical records. Today, all of our medical records are stored at a doctor's office, and if we want to go visit another doctor, we have to get those medical records transferred. So rather than having one kind of, uh, I want to say, a collection of medical records that I own, it's a little bit more manual today, and I think it would be easier if all our medical records were published, and this is not publicly published. This is obviously under under security that I would have, where I have access to it, and I would give others access as needed, i.e., doctors or what other medical specialists I'm seeing. Then they would basically be able to see my records in real time and my medical history. So that would be I think a great use case of what blockchain tech could offer is in the healthcare world, where I'm really owning my own medical records and I can give access to those who need it. And it's not necessarily on pen and paper. It kind of opened my eyes. I had a newborn son this past July, and just seeing how manual the process was very eye-opening into how far behind the healthcare industry or hospitals are. So I think we really need to bring tech space into the healthcare industry, because I really think there could be a lot of good work done there. And then another use case of what blockchain tech could offer is in just like personal identification. So really publishing and owning my own personal security, my social security number, my birth certificate, bringing that into a digital ecosystem rather than having, like currently I have my birth certificate in my safe at home. If I lose that, I'd have to figure out, I wouldn't even know where to begin to get a new one. Same thing with my social security number. So I don't carry that around with me, but I think this would cut back on personal theft, where you don't have the physical numbers. It's more so secured digitally through a variety of passcodes, passphrases, two-factor authentication, things like that to access, and it would be much more secured. And I think it could help cut back on personal identity theft, which we're just constantly seeing. And I think as we think about big data and we're always kind of giving up our privacy, I think this would help kind of supplement that to support kind of owning our own information, if you will. But yeah, like I said, I'm a big proponent of crypto. Without crypto, you can't really have blockchain tech without crypto, or you can't really have crypto without blockchain technology. So they go hand in hand. That's why I wanted to talk about both today. And yeah, I mean, I'll leave you with this one. I always like to give a fun fact when I'm giving these presentations. The first, if anyone isn't aware, the first Bitcoin transaction. So I mentioned Bitcoin came around in November 2008. That's when the Bitcoin white paper was published. I wouldn't say Bitcoin really came to mainstream or popular until probably about 2012, 2013 is when it really started to gain some traction. But the first Bitcoin transaction actually happened in May 2010. And that was basically posted to a Reddit user. Someone wanted to buy 2 large Papa John pizzas. Now, what was the cost of that, of those 2 large pizzas? I could say to date, those are the most expensive pizzas. The cost was 10,000 Bitcoins, which at the time was a total of roughly $30 USD. And if I'm factoring today's Bitcoin price, let's call roughly $50,000 just based on market fluctuation, that would be over $500 million for 2 large pizzas. So I always like to just kind of present that when people think of they don't have the opportunity, or maybe they missed the boat in Bitcoin. Think about spending $500 million for 2 large pizzas. So I know I wouldn't be a happy camper myself. And I always like to kind of present that just to put it in perspective, because it's always neat to see the first Bitcoin transaction was 2 large pies. Here is my information. If you have any additional questions, I am always happy to talk about digital assets, talk about cryptocurrency, talk about blockchain technology. I've been working in this space for a while. I've seen the ups and downs. I've seen the different market swings every year or something new. I'm always happy to help. If you're new to this space, if you're thinking about getting in, please reach out to me. Let me know. Always happy to help. Thank you so much for today's presentation, and hope to hear from you.